GPT has seen its first half fiscal net loss widen to $1.2 billion, though solid improvements continue to build its reputation as a takeover target. Analysts see minority shareholder Stockland potentially launching a bid for the Sydney-based commercial property company after the latter's efforts to focus on Australia and sell off its overseas assets. Business Channel reporter Kai Chow spoke with CEO Michael Cameron and asked him whether he could get good prices for them, particularly after having to sell tourism assets at a 40% discount.
Well, it's important that we achieve our strategy and implement that, but we're not forced sellers and we're not in a hurry to sell. In the case of the tourism assets, there was a number of islands in Queensland, a very small part of the portfolio, and we were keen to move quickly on those.
Is this the right time to sell those assets, though?
Well, they don't really fit into our portfolio well. They're highly volatile. They give a very interesting return profile over time. They need continual levels of capital investment. And look, we just thought this was a good time to be getting back to the basics that we do well.
So it's that important to get rid of them, even if you don't get a price that you like?
Oh, look, as I said, they're a very small part of the portfolio. And out of a $10 billion portfolio, this was only $85 million, so a very small piece of the business.
So where will growth come from going forward?
For us going forward, it's about simplifying the business and getting back to a very core portfolio based in Australia and looking at our competitive advantages of the quality of our book, the culture within the organisation, the scale in the across the book as well. We think we can add significant value to our existing portfolio.
Would you consider moving into other areas, for example, residential property?
No, we're happy with the three parts of the business that we operate in, with retail, office and industrial. And that gives us good diversification across the Australian market.
The market for residential property at the moment, though, it's booming.
Residential is attractive, but it also has a fair bit of volatility in there. And we know a lot about office and retail and industrial, and I think we should stick to our knitting. And it's been a trust that's been operating for about 38 years, and we've done very well in those sectors. And it's about getting back to basics and doing what we do best. And whilst residential, sure, does offer some attraction, not for us.
So that would suggest that you're really not that open to a bid from Stockland to buy GPT.
Look, I think that's fairly old news now, and for us, from a strategic perspective, we don't need any more scale or any more capability. It would only be a case of if it was a knockout financial bid, and we'd operate like any other company in Australia. The directors would consider it, and if there was some value in it for our unit holders, we'd put it to a vote. But I can't see that happening in the short term.
How about acquisitions of your own? What would you consider there?
Yeah, for us, our strategy really is to sell our non-core assets and get back to a very basic Australian-based company. Once we've completed that, we may look at opportunities to acquire other assets where there are opportunities. That may involve companies, I don't know, but at the moment, our focus is totally on cleaning up the business and restoring the confidence and trust in GPT.
What's happening with dividend policy? You've got a constitutional change at the moment under proposal that would involve more flexible funding.
We're not making any changes to our distribution policy at the moment. We're still sticking with the current policy, which is to distribute about 90 to 100% of our earnings. I did indicate that going forward over the next 12 months, we will probably move to change our constitution to give us flexibility in the future.
Turning to economic outlook, what do you think could derail any economic recovery?
Well, I think if you look at the US, the level of confidence there is absolutely key. And whilst I see house prices are starting to return and show some growth in the US, the levels of debt are really quite scary. So I describe the environment or the economy there as very fragile. And I think whilst Australia, there's a quite level of confidence emerging, and all of the indicators such as employment and those sorts of things are looking much more positive than they were 6 months ago. There's still a risk that any overhang from the US, if there is bad news there, will impact Australia.
What's the state of the rental market in this environment?
Yes, we're in a very strong position. About 99% of our shopping centres, our industrial estates, and our office towers are rented, which is a good position to be in. We've also got very, very long lease terms in our offices. That's about 5.5 years, in our industrial parks around 7.5 years. So if you think about where the cycle is, and we're probably heading towards the bottom of the cycle at the moment, over the term of those leases, you would expect that we'd see a fairly strong position for us going forward. The other issue, of course, is that demand continues to soften, but supply has basically stopped right across the eastern seaboard. So when things do pick up, again, I think we'll see quite a sharp uplift in demand.
And what do you think would be needed to fix this supply issue?
Well, I think a level of confidence across the construction industry when developers are willing to get back into the market and begin construction. But if you look around Brisbane, Sydney, Melbourne, there are very few cranes, and which is very different to the last cycle where it was very much an oversupply and a lack of demand. So very different this time around.